And today we are diving deep into the activity around USA Rare Earth Inc., that's ticker USR.
Right, and this stock has, it's surged over 11% in a single day.
Just incredible.
It is, and the analysis we've been looking at really sets up this fascinating, almost binary choice for you, the investor.
Now,
So our mission today is to get past that headline number to really analyze the data points and answer one key question.
which is?
Is this sudden spike just a one-day wonder, some speculative heat? Or is this the ignition point for a massive short squeeze, one that could put USR into the $20, $30, or who knows, even higher?
That framing is perfect because the starting point, the fact of the matter, is undeniable. USR closed yesterday at $17.52.
Confirming that 11% surge.
Exactly. And a move like that, especially for a company in such a vital sector, it just demands a proper investigation.
It absolutely does. When a materials company, especially one tied to, foundational infrastructure, makes a double-digit move like this, the market is sending a signal.
Right.
The question is, what is that signal? Is it a new valuation floor, or is it just a temporary imbalance caused by, distressed short sellers?
So where do we begin?
Let's start with the technical action, the thing that kicked it all off.
Okay, let's unpack this supposed textbook breakout. The initial price action that the analysis details, it happened with incredible speed.
It wasn't a gradual climb at all.
No, it immediately gapped up to $16.40. So for the listener, what exactly does a gap up signal in terms of, market dynamics?
A gap up is crucial. It means the price it jumped overnight, completely bypassing the normal trading range.
Okay.
And that tells you there was strong, non-discretionary buying pressure queued up before the market even opened. Buyers, and we're often talking institutions here, were so eager they were willing to pay a premium just to get in first.
That urgency really set the stage for the rest of the day.
It did.
The stock then tested $18.21, hit that high, but it finished strong at $17.52. It locked in that nearly 11% gain.
And the fact that it held that gain is so important, often more important than the high itself.
How so?
A high can just suggest a moment of peak enthusiasm, maybe some volatility, but a strong close that suggests conviction. But here is where the story gets really critical and where we see that institutional conviction truly reveal itself.
You're talking about the after-hours trading.
Exactly. The sources call this the kicker.
Right. The stock didn't just hold $17.52. It pushed another 3% higher, trading north of $18 after the bell.
Correct. Now, I know what you might be thinking.
That after-hours volume is thin.
It's notoriously thin, so could this just be noise, easily exaggerated by a few small trades?
That is the critical challenge. If the volume is so low, how do we know it isn't just an unreliable blip on the screen?
We have to look at the context. When the after-hours buying matches the momentum you saw intraday, and it pushes the stock past a key psychological level like $18, it often confirms larger players are involved. They're making these trades post-market because they don't want to wait.
They're chasing the price.
They are chasing the price. It's a telltale sign of major funds accumulating. They have a mandate, they see the breakout, and they worry if they wait, the price will just run away from them.
That institutional fear of missing out. FOMO.
That FOMO is the absolute bedrock of the short squeeze thesis.
Which brings us right to that central dynamic.
Yeah.
The analysis suggests all the mechanics are lining up for a pretty dramatic supply and demand crisis here.
They are. The whole thesis really relies on three sequential events.
Okay, what's first?
First, the volume explosion itself. Just massive relative volume spiking hard on a green day. It's like a flare being shot into the air.
And it catches short sellers completely off guard.
Completely. They're betting on drift, on decline, not on sudden explosive surges.
And that volume explosion, it leads to the second piece, which is the trap. The analysis says anyone who shorted the stock below $16 is now, quote, underwater. We should probably clarify what that really means for a short seller.
Being underwater it's the point of financial pain. It's where the current market price is higher than the price they originally sold the borrowed shares at.
So they're losing money on paper.
They're losing money, yeah. But the real danger isn't just the paper loss, it's the margin risk.
The margin call. Explain how that forces their hand.
So when you short a stock, you have to put up collateral, right? Margin. It's to cover your potential losses.
Okay.
As the stock rises, your brokerage sees that loss growing, and they demand you deposit more cash to maintain the position.
And if you can't?
If you can't meet that margin call, the brokerage forcibly liquidates your position. And to liquidate, they have to buy the shares back immediately, regardless of the price.
Which leads to that third element, the mechanism of covering.
Exactly. Whether it's forced liquidation or just them trying to manage their risk, that mandated covering just adds to the existing demand.
Creating a feedback loop.
It becomes a runaway feedback loop. The short sellers become forced buyers, which pushes the price higher.
Which traps even more short sellers.
Who then also become forced buyers. When this happens fast, you see what the analysis calls a parabolic move, an extreme, unsustainable upward curve.
But the volatility in that kind of move,
Yeah.
it can be brutal. If the squeeze doesn't happen or if that buying pressure just evaporates, what's the risk?
That's the critical risk.
Wouldn't this come crashing back down to reality just as fast?
It could, and that risk is amplified by the low float dynamics specific to USR.
Okay.
Since USR is a developing company, it has a tighter float. Fewer shares are actually traded on the public market compared to, say, an Apple.
Fewer shares available means more volatility.
Exactly.
Yeah.
When you have fewer shares, any large buying or selling order has a much more dramatic impact on the price. There's just not enough liquidity to absorb it.
It's a multiplier effect.
A huge multiplier effect. It means if the squeeze takes hold, the move will be quick and violent. But the reverse is also true. If those institutional buyers suddenly stop, the price drop can be just as swift and just as brutal.
So the low float is a double-edged sword. It enables the squeeze, but also elevates the risk.
Perfectly put.
That gives us the full technical picture, and it makes a compelling case for some serious short-term upside. But, as we always stress, a move like this needs more.
It needs fundamental backing.
Right. This is not just a technical trade.
And if we connect this to the bigger picture, the fundamentals are what stabilize the floor once all that technical dust settles.
And what's fascinating here is that USR seems to operate at the intersection of two of the most powerful economic forces right now.
National security and the green energy transition.
The core issue being energy independence, specifically for rare earth elements. We all know these materials are critical, but why is the urgency hitting the market now? What makes USR a strategic asset today?
Because the applications are, simply put, irreplaceable. And the supply chain is seen as an acute vulnerability.
We're not just talking about electric vehicles.
No, not at all. I mean, the motors in EVs are a huge part of the story, but we're also talking about highly specialized, high-performance magnets.
The kind you find in defense systems.
Exactly. Things like stealth aircraft, missile guidance, advanced radar. These are the components that give modern defense systems their edge.
So when the U.S. government talks about securing a domestic supply chain, they are laser-focused on these specific materials.
Absolutely. And that brings us to USR's Round Top project in Texas. This isn't just another mine. The analysis highlights its strategic importance because it's positioned to supply heavy rare earth elements.
Which are the rarest of the rare.
The rarest and most difficult to source outside of foreign control. This completely shifts the market's perception. It goes from being a speculative mining venture to a vital piece of national infrastructure.
And that justifies that strategic premium we're seeing get priced in.
I think so. The sudden volume spike and the technicals, they're not just random noise. They're drawing institutional eyes to a company that was, you could argue, fundamentally undervalued given its strategic importance.
So the technical catalyst is forcing the market to finally address the fundamental story.
Exactly. The short squeeze might be the match that lights the fire, but the structural wood underneath it is the strategic importance and, this is crucial, the execution timeline.
Investors are notoriously allergic to perpetual planning.
Yes. And that is why the analysis emphasizes 2026 as this massive inflection point.
A date that marks a decisive shift.
It does. Investors are factoring in the transition from that long, capital-intensive planning and permitting phase into the execution and production phase.
Which de-risks the whole project.
Significantly, it moves the entire conversation from speculative possibility to tangible asset creation and expected revenue. It completely shifts the discounted cash flow model.
And Wall Street seems to be validating this outlook. The consensus is a strong buy rating across the board.
Yes, and the formal analyst price targets are, well, they're pretty compelling. They range from 23 to 26 cents.
And considering the stock closed at $17.52.
Reaching even the low end of that range is still nearly 50% upside from here.
Wow.
That's a massive signal of conviction that the fundamental value is significantly higher than where it's trading. The analysts are basically saying the squeeze is just accelerating an overdue re-rating.
That dual catalyst makes the volatility a lot easier to stomach.
It does. Because you have a strong argument that even if the short squeeze fails, the stock still has a robust fundamental floor supported by national necessity.
Okay, so let's synthesize this into an action plan for you, the listener. Let's focus on the key levels defined in the source material. For those already in USR, it sounds like the game is to ride the wave.
Pretty much.
But for someone on the sidelines looking for a safe entry point, what is the classic buy the dip level?
The whole plan really revolves around confirming that yesterday's breakout was valid, so you need to watch the $16.50 level very, very closely.
Why that specific number?
It's a classic tenet of technical analysis. The $16.50 level was the major resistance that the stock struggled with yesterday morning.
Right.
Once resistance is broken, it often flips and becomes the new support level. It's like breaking through a ceiling and then being able to stand on it.
So if the stock pulls back to $16.50 and finds buyers,
It confirms the breakout is genuine. not a fluke. It tells you the old trading range is officially history.
That's the defense. Now for the offense, what are the resistance levels that confirm the squeeze momentum is continuing?
The first and most crucial hurdle is holding the $18 level. We saw it test that level intraday and then push above it after hours. If it can sustain trading above $18 during regular market hours, that validates the institutional chase we talked about. It confirms the short sellers are truly losing their grip.
And that sets the stage for the next much bigger challenge.
The big psychological resistance level.
$20.
Exactly. Round numbers act like magnets in the market. They're psychological barriers. Clearing $20 is a massive statement.
It puts the stock in a whole new valuation bracket.
It does. It often triggers algorithmic buying, and it just shifts investor sentiment towards accelerated growth. In the market lexicon, clearing $20 is the point where a stock is truly off to the races.
And those analyst price targets of 23 to 26 business suddenly feel much closer.
They feel very imminent at that point.
So to synthesize this deep dive, USR is being driven by this cocktail of powerful forces.
On one hand, you have the immediate explosive power of the technicals. The low float volatility, the volume surge catching shorts underwater.
Institutional urgency.
All of that. That's the short-term fuel.
And on the other end, you have the strong structural foundation.
The national importance of Round Top, the government mandate, the confidence in that 2026 execution phase. All of that provides the long-term upward pressure.
It's a rare and potent combination.
It really is. USR isn't just benefiting from market speculation. It seems to be leading the charge in a sector that's just. It's viewed as strategically undervalued.
But the key is to watch those levels.
Absolutely. Maintaining momentum above $18 and assaulting $20 are the necessary steps to validate that broader fundamental thesis.
We've established the strong buy rating and the professional price targets that indicate nearly 50% upside, all built on this narrative of real domestic energy independence. And that raises a provocative question for you to consider as you digest all this. If USR successfully clears that psychological $20 barrier and starts moving convincingly toward that $23 to $26 analyst range, what is the true structural price the market is willing to assign to a company that promises to break reliance on foreign sources for the world's most critical high-performance magnets?